Hi everyone, hope you're all doing well, and today I'm going to talk about how many stocks should you own in your portfolio. It's a question I get asked quite a bit on the channel, but I've never made a video about this, so I thought it'd be a really good one to do. I've covered it on Patreon, but I've never actually covered it on the main channel. If you do want to join Patreon, the link's in the description. And yeah, we'll go through how many stocks you should own depending on what your portfolio size is. Now, I actually made this video once, but I'm refilming it because I watched it back and I was like, I can do it better than that. So we're going for the second attempt now. So yeah, we'll go through everything here, and I'll kind of put some rules out there that really does help you and how you should structure your portfolio. So yeah, we'll get cracking on everything with this to do today. So the first rule, the main thing that I want you to take away from this video is it's always important that as long as you can keep up with your stocks, that's fine. That's probably the main thing. You know, if there ever comes a point where you're unable to keep up with your stocks, that's probably the big sign that you've got too many companies and got too many to keep up with. So that's the number one rule that I just want you to take away today, is that as long as you can keep up with your stocks, you're not doing too bad. So what I mean by that is that if you invest into a company and your company is reporting earnings, which pretty much any US company does every 3 months, if you are like, oh, I didn't even realize my company was reporting earnings today, or I didn't realize they reported earnings last week, that's probably a sign that you've got too many companies, because those are sort of the key information you should be keeping up with. And if you're not, then you need to kind of have a think and see what's going on here. The other thing as well is, if you don't have to keep up with every news article that's out there, but the really big stories to do with your company, you should be on top of that. So for example, one of my companies, which is Boohoo, reported they were buying 2 new brands a few weeks ago. And because I keep up with that information, I really know what's going on with my stock. So that's something that I always want to keep up with. So that's one rule that I really want to take away with. That's one of the big things, is as long as you can keep up with your companies, you're not doing too bad. And that's one of the main things. You can pretty much turn the video off now and not watch anymore, because that's the number one rule. But yeah, that's definitely the thing that I want to take away from this video. Another rule, which I haven't wrote down here, is that you do want to have at least 5 stocks, because that's not really a portfolio. You know, if you're having less than 5 stocks, you're putting a big chunk in your wealth in one company, and if that one company was to go, something happened with that company, it would really destroy your portfolio, your wealth, because you probably have a lot of your wealth tied up in that one company, and that's not having a really good diverse portfolio. So you do want to keep at least above 5. Another thing I would say that works on the other end of it is that you want to have not too many stocks. So, you know, if you ever to have 50 stocks, it's a lot of stocks. That's kind of like an index. And the thing is, like an individual stock picker, is that you want to try and pick only the couple of best stocks that you can find. So if you went down the S&P 500, for example, you wouldn't want to own all the companies, because you would want to outperform it. So you want to try and pick the 10 best out of there, the 20 best out of there, the 30 best out of there. And that's how you outperform the markets. You want to try and pick the very best stocks to have in your portfolio. That's why you're an individual stock picker. That's why you want bigger returns. That's why you try and outperform the indexes, is that you want to really be picking the best stocks. You know, you want to be picking 10 out of 10 stocks, or maybe even 9.5 out of 10 stocks. You want to be picking the best of the best. You shouldn't be investing into companies that are only 7 out of 10s, you know. You want to be having the best in your portfolio. So that's something that you always want to key, you know. There shouldn't be ever a point where you're 50 companies as 10 out of 10 stocks, you know. There's no way you should be able to do that. So that's one thing as well, the point of view of make sure you're diverse. At the same time, you never want to be in a position where you've got 50 stocks, because you're just going to perform okay. You know, you're way over diverse. You're never going to be able to beat the market, for example. You know, there should only be a little amount of stocks that you are that's a really good stock, I'm going to invest in that one. So those are 2 little rules as well about, you know, having not too many and having loads. But definitely the main thing is that, you know, make sure you're still keeping on top of your stocks. If you're not keeping on top of your stocks, it's probably that you've got too many. So I kind of broke down a few figures here. So first of all, I think most of my viewers kind of come in this sort of category. I'd say 50% of my viewers probably come in this category. And the people that come in this category are either, well, I would say mostly newer investors. Sometimes newer investors might jump and put a lot more money in, but I think mostly new investors, and I would say that about half of my audience will come in this category. The new investors. And if you invested 0 to 20k, you're probably newer in the market, you are only edging yourself in, you're trying to build your confidence up in the stock market, and eventually you'll get to a point where you're like, oh, I really like this stock market stuff, I can see myself making good money. You're probably then going to start pushing up into these categories. So you're probably new, you're probably building up your confidence, and eventually when you start building up your confidence, you're probably going to move down to these categories. And the thing is as well, is if you're starting with your 0 to 20k first investment, is that after a couple, 12 months, 24 months, even a little bit more than that, if you are doing really good investments, you should see your returns start coming in as well as your new fresh income that you'll be putting into your portfolio. So you'll probably be breaking this barrier pretty quick and getting down to these categories. So you're probably going to start off in this category within the first kind of 12 months. So if you're kind of in this 0 to 20k category, you should have around about, in my opinion, somewhere around 8 to 12 stocks. Now, the big thing that I see in this category, where there's the big errors that I see, is that I see people in the 0 to 20 category, and maybe not the 20k, but a little bit more lower down, maybe the 0 to 5k, maybe even sometimes the 0 to 10k, is what they do is they invest in 20, 30 stocks, and they are very diverse, and too diverse in a bad way. Because what I see sometimes is people that are investors that are in this lower end is they don't remember to buy only the best of the best stocks. But as well as that, what they do is they invest maybe £200 into one company when they've got a value of 5k or maybe even a bit more than that. They only invest 200 in here. Now the problem is with investing 200 is that to look into a company, you're going to do probably about 3 to 10 hours research into that company, and then you're going to do the little maybe 1 hour every 3 months just to keep up on top of it, maybe the 2 minutes that you do every weekend just scanning the news articles on that company to keep up with it. You're going to put 3 to 10 hours maybe over the course of the year, you maybe even going to 15 hours of keeping up on top of that company. Now the problem is you might have less money, but that doesn't mean that you put £200 into a stock and you let it sit in a stock for 2 years, and then let's say, I always like trying to get 100% return on a company. If you put £200 in a company and you do all that research and you get 100% return, you only make £200. Now I don't know about you guys, but to have your money tied up in a stock for 2, 3, 4, 5 years, to put in 10 hours of research, to then only go make £200, doesn't make sense to me. You're spreading yourself a bit too thin. Have a little bit more chunkier positions. Let's say you've got a 5k portfolio and you go 10 stocks, that's £500 in each stock. At least then when you put 500 in and you get 100% return, you get £500 rather than 200. And it's just a little difference that make, I sometimes see a lot of beginners that get invested in the stock market and only put a small amount in every company, £100, £200, maybe even less than that sometimes. And it's like, what's the point? What's the point of doing 3 to 10 hours of research, having your money tied up, to then only go make £200? Be a bit braver, don't spread yourself too thin and get them big returns. So only buy the best of the best. And that's a common mistake, a common error that I see in this area. They spread themselves too thin, and they don't make, great returns from that. Or they can make great returns, but because they didn't invest that many, they don't get great returns. So that's definitely a mistake that I see in this category quite often in the 0 to 20k category. So I think 8 to 12 gives you a good ability to have a very diverse portfolio and have nice chunks of cash in them stocks to do really well. Now, from 0 to 20k, you're probably then going to move up to the next category. You're probably in the stock market, probably at least over a year now, or you've just kind of jumped the step and put more money in because you got confidence that you're not going to fail, I guess. But you're probably building up. This is kind of, I'm saying this from like if you were kind of like 20 to 20, in fact maybe even younger than 20, around that sort of age. Now you're probably about 12 months into the stock market. You're building up a bit of confidence. You might be getting some good returns. Now you're going to step up a little bit. You're going to go from 20k to 50k. Now because you have a bit more money here, you probably now have some of these investments that you did earlier on are starting to build up. You probably want to buy a few new companies. and you've also got a bit more money in there, so you want to be a little bit diverse. Also lets you cover a few more sectors. So you're probably going to break your investments up a little bit more. You're probably going to step it up to 12 or 15 stocks, and that's somewhere that you'd probably want to be around that sort of category. Now, when you start to get into 50 to 100k, we're starting to get into some a little bit more serious, really, into investing now. You know, you'd probably be in the stock market for a few years now, and hopefully you've got some good returns. You've got some really good positions. You're also putting a lot of money into the stock market. You probably want to diverse your income now, and at the same time, in them kind of few years, you're going to probably see some opportunities where you want to step up and buy them stocks. You know, maybe you've seen a stock market totally dip and you bought a few more companies. Maybe a stock's totally fallen off the cliff after earnings. If you're at this sort of point now, you want to diverse your portfolio a little bit more, and I would say 15 to 20 is where you want to go. Now, like I said, these numbers aren't exact. You know, you might want to have a few less stocks, maybe you want to go a little bit higher. This is just kind of my suggestions, but I believe somewhere around there kind of then, you know, doesn't spread yourself too thin. You can be able to put some chunks into the stock market. Now, if you're around this category, 100k and plus, obviously that leaves a very broad range. I put 15 here to 25 to 30. Now, obviously, it doesn't mean that you get to 100k and then you go to 30 stocks. Obviously, that's probably if you're getting a little bit more higher than 100k, but at 100k, you do want to make sure you keep yourself a bit of a diverse portfolio here, so you can afford to have a few more positions. As well as that, you're probably going to start think about probably going into different markets. You're probably thinking about picking up different investments in the US. You're probably going to start thinking about picking different investments up in the UK, maybe China. So you definitely at 100k, you're going to have probably a lot more of a diverse portfolio, and you're probably going to be covering quite a few markets here. So overall, I think that's a great, you know, structure of how to position yourself with your portfolio size. But overall, my number one rule is to make sure that as long as you can keep up with your stocks, you're doing something right. So as long as you keep up with them earnings, them news articles, then you should look like you're doing okay to me. But those are kind of my suggestion of ballpark figures of how many stocks you should own at each amount. Now, I was going to do a separate video, but I'm actually going to do, I'm going to do it in this video as well because I think it ties up nicely with this. So with these portfolios, sometimes these are some of the errors that I see. So what I'm going to do is I'm going to draw a pie chart of, so this is my pie chart. I know this is not amazing, this is why I'm not an art teacher, but this is my pie chart. Now what you should do in these portfolios is you want to kind of have a good chunk of your portfolio here, and I'm going to mark these as the blue sections. These should be your three major holdings in a portfolio. These three should be, you should take these three stocks as, if I was only able to invest in 3 stocks, these are the 3 that I would pick. And these 3 stocks should be probably more developed companies with a decent market cap, hardly any risk to them. So there's definitely no chance they're going to, you know, go bankrupt or, as far as you can see, any major drops. Should have decent growth and also should have good balance sheets. So these should be your 3 core holdings, stocks that you would be very happy to be your only 3 stocks, and you could lock them away for the next 5 years and not touch them. So you should really build your portfolio up around, in my opinion, 3 core holdings. Now, when you do get to high amounts, you could have more than 3 core holdings. You could have 5, maybe 6 core holdings. But I'm just basing like this portfolio if you're in this amount or if you're in this amount here. So you want to have nice 3 core holdings. Now, if you were to pick up some more stocks, these would make probably maybe have a little bit more risk, but still very solid companies that are a little bit behind these core holdings. So these would make up some smaller sections. We'll have 1, 2, 3, 4, 5. So you could have here 5 smaller sections, 1, 2, 3, 4, 5. And even if you really wanted to, you could argue that that's a quite big chunk. So you have the other smaller stocks here. So we've got 6 smaller stocks. So we've got 3 core holdings, 6 stocks that you aren't as confident on, maybe have a little bit more risk, but still 6 stocks that you really like that take up the other parts of the portfolio up. So overall, we've got the 6 other smaller stocks here and 3 core holdings, and that kind of puts us on 9 stocks. Now, one thing that I do see quite often, and this is one of the big things that why I wanted to do this today is this little this little chunk here is what I call the spec part, or you could call it the SPAC part, with what kind of code is going on in the stock market at the moment. And this little section here should be the stocks that are very small in market cap, that do have a little bit more risk, and this wealth here, it should only make a small section of, and it should make it a bit of a section where I could maybe lose that money. Obviously, you don't want to go in that situation like I want to lose money, but plan for the worst case scenario, if you get what I mean. And in this section, in my opinion, you could split this up into 3 companies. So we've got 3 companies there, 1, 2, and 3. And these 3 companies are your higher risk companies. The companies that maybe could go up quite a few 100% in the next few years. At the same time, they're still in early development stages. There's still a lot of risk to them. They're probably a small market cap as well. So just for example here, 3 of my spec stocks, Card Factory. Another one you could say is EHang. Another one is Planet 13. So Card Factory has a few financial problems. If it gets through the financial problems, it could go up huge, but it does have financial problems. Another one is with EHang. Kind of don't really have that many sales going on at the moment, but if they smash it, the stock could go up absolutely huge. But there's a risk there. They've not really got any proven sales at the moment. The other one, Planet 13, probably the least risky out of them all, but it's a penny stock. It's not on a major index, and it only takes up a small position. And this is what I mean. I split these up into 3 smaller spec stocks, because what I see quite often is one of those spec stocks doesn't take that little position of the portfolio up. It takes this position up. And this is why sometimes people can have their portfolio move so much, and also potentially can get burnt so much, is because what should be their smallest position in their portfolio ends up making one of these bits up. And that's a really risky thing. And when we're in what we have at the moment, where we have a bull market where everyone thinks they can't lose money, they're undefeatable, the confidence goes up, and this small specs section starts making up 2 sections, and sometimes it makes up 3 sections, or maybe even one of these companies makes, like I showed you earlier, makes that one company starts making up a core holding, and that's when the risk you come. That's why you'll never see any of my spec stocks ever come a major holding. A few times here, this is why Gang has never come a fundamental company in my portfolio, because for me, that company is still very early stages. There's hardly that many risks to it, but it's definitely not a fundamental company with a proven track record, and that's why it could never make that position. That's why my core holdings are companies like Microsoft, like Visa. They take up a nice core holding because they're proven companies with big market caps, safe balance sheets, a proven business model, and not too much risk to it. Facebook, you can argue, but hey. So that's one thing that I want to talk about. So hopefully this gives you kind of a breakdown of, these are hopefully some good suggestions of how many stocks you should hold, and not over diversing, not that you come an index. Remember, you only want to select the best of the best. But as well as that, you're not spreading yourself too thin, and you're putting only money in, and you're spending hours of research, putting £200 in or something. You do hours of research, you have your money tied up for so long, and you only make £200. You want to make a bit more money than that, and make sure you keep some big chunks. So yeah, hopefully that kind of structure of how many positions you have helps, and hopefully the structure of how a portfolio helps, because like I said, this is one little thing that's I've started noticing in the last few days, which does worry me a little bit, and hopefully that's a good way to structure a portfolio. Like I said, that should have been a separate video, but we've been on a good roll, and hopefully that gave a lot of information out in this one video. So like I said, it's an education video. These don't normally do well, so all I ask for is if you could smash the like button, it'd be absolutely amazing. If you do want to join Patreon, we've covered this a few times on Patreon, links in the description. If you do want to start investing, there's a link to a free trade account. Open a free trade account, you also get a free share, which is pretty good. But thanks so much, hopefully this was useful, and if you could smash the like button, and I'll see you in the next video.